in the short term. And unfortunately, that sort of short-termism or short-sightedness is behind a good deal of the problems we have at the moment. There's a price to be paid for focusing on these elements. Now, I'm happy to be talking about the medium term today because the short term, well, I'll leave you to fill in your own quotes into that second phrase there on the screen. I don't doubt some of them would be interesting Anglo-Saxon terms, but more significantly, I suppose from a planning environment, again, we're facing into a situation where we're preoccupied almost exclusively with the short term. What will happen in the next week? What will happen in terms of financial markets in the next day? And in terms of the economy, when are we going to see this sort of turnaround? My presentation today looks a little bit beyond that. I'm concerned about what happens in the medium term, but I suppose you can't really just, as a good economist would do, assume the medium term is suddenly here. So the first part of my presentation deals with how we get there, and then I'll make some comments about how different the future might look. How we get there, well, the short answer, or the short comment, is that it will be a very bumpy road. It will be a particularly bumpy road in the near term because in some respects it's a road through a minefield. And the first mine that we're looking at the moment is Greece. Everyone is deliriously happy today. Overnight the Greek bond deal was agreed and there is peace in the world. We've been in this situation lots of times in the past. The reality is the Greek situation is very difficult to see being improved anytime soon. If you look on the left-hand side of this graph, this shows you in blue the sort of deteriorating conditions assessed by the Troika looking at Greece. In red, they're looking at what they expect to be an improvement in the structure of the Greek economy. I wouldn't bet the bank on that one. Overall, what they're seeing is, in spite of that improvement, the outlook continuing to deteriorate. So, the second part of the slide is a testimony to the unquenchable optimism of the human condition. It's that Greek debt will come down from the current level of 160 to 120% of GDP by about 2020. There's huge risks around this. It's very difficult to see how in any sort of normal set of circumstances we'll get there, but there is an aspirational element to this. And that aspiration you'll hear in terms of the comments from European policymakers who say great things in terms of their expectations for delivering Greece out of the current crisis. I think most analysts now believe that the real focus of attention among policymakers isn't to deliver Greece out of the crisis, but to move them to a safe area where a controlled explosion can occur, where the collateral damage to the rest of the world is fairly limited. That may sound very cynical, but it's the real situation we face in Greece at the moment. And what that means is that the environment over the next while continues to be uncertain, to be very, very tricky, very dangerous, very nervous, and we're going to continue to have these obstacles really lasting right through into the medium term. That's overlaid on a fairly fragile world. This graph shows you economic activity, a composite measure for the global economy. Above 50, things are improving. Below, they're deteriorating. We pulled out of the death dive in 2009, but the subsequent history is fairly limited, in large part because we've made significant policy errors. And here's history, if not repeating itself, at least chiming. When people talk about the Great Depression, most analysts realise that what made it great wasn't the initial downturn, but the policy errors that followed it. And we're still in that tricky period where there's the risk of something happening because of a French election, because of a Greek election, because of some unforeseen event on the other side of the world. And those all putting a very delicate situation in the global economy at the moment. To translate that into the Irish situation, this shows you in a variety of ways what has happened in the Irish economy over the last 15 or so years. Now, the graph and the slide, given that it's a fairly wide screen, probably doesn't do full justice to the severity of the downturn that we've seen. If you look at the graph, you'll see that GDP, which is the red line, is down about 12% back to 2005 levels. The blue line, GNP, is down about 15% back to 2004 levels. And the black line, although it looks very smooth as anything but, that's employment. And that's also down 15% back to sort of towards 2003 levels. That's about 330,000 jobs. It's a massive, massive change in economic circumstances. So we've rolled over and rolled significantly back into the past. The good news is that there are signs that a tentative stabilisation is underway. You can see that in terms of the trend in GDP and GNP for the last couple of years. And encouragingly, we saw the first very tentative signs of an improvement in employment and numbers released on Wednesday. It's still very fragile, and it will remain so for the next 3 or 4 years at very least. But there are signs of an improvement there, which is hugely important. It is also hugely important to remember that financial crises do end. And in that context, what I've done over the next couple of slides is look at other financial crises. This one is Thailand. Right now, most of you won't have looked at the Thai economy, but the reality is that it was at the centre of one of the most significant crises of the last decade. In the late 1990s, the Asian crisis was the key focus for attention globally. And what you see there is a very severe downturn in the Thai economy in the blue line in 1996. A subsequent rebound in the economy took to about 1999, aided and abetted hugely by a sharp devaluation of the Thai baht. And you see the property market, that's construction in the Thai market. And what's interesting there is, again, falls off a cliff. Prices were down about 40% in domestic currency terms, so you're talking about 70 odd probably in US dollar terms. It eventually starts to stabilise and marginally improve around about 2002, 2003, but it really takes you onto 2004 before you begin to say the worst is clearly over and a modest improvement is happening. For the next 5 or 6 years, it bounces along the proverbial bottom, and then you see some slight improvement, unfortunately for Thailand, just as the next global crisis comes along. So what this suggests is that you do see a much slower turnaround in property markets, that economies get back up and running, and that eventually drags the property market. You don't get it back to the same sort of level of activity, and it is still vulnerable to financial problems elsewhere. The same message comes from looking at Finland. In the early 1990s, again, excuse me, the black line shows you the scale of the downturn in GDP, about the same as Ireland, about 13%, unemployment up from about 3% towards 20%, and house prices down again, about halved after rising nearly double the previous couple of years. Again, you see a period where the economy begins to improve. It again predates the property turnaround quite significantly. You're talking 7 or 8 years there again. The good news, and maybe some of you should stop listening now, is that after that time, property prices in Finland start to rise and continue to rise gradually. So, but it's in the context of a very different economy and the little matter of Nokia as well. So you get those sort of turnarounds, and the point of this is to say that eventually property prices do wear themselves out, and after economies turn, so do properties. But I still have to make the case for why the Irish economy will turn. What I've tried to do in that first couple of minutes is suggest to you that there will be a dare, that we will eventually get there, even if the road ahead is going to be very tricky, very uneven, 2 steps forward, 1 step back. But it will take us to a very different place. The future Ireland will not be anything like the past Ireland for a wide variety of reasons. And I want to talk about those now. The first is that the world itself looks very different. Again, I don't know if you can see the scale that fully here. That black line is the US economy. The size of the US economy has multiplied by about 2.5 since 1970. Not a bad performance for a a mature economy. The Irish economy over the same time, about 4 times greater than it was. The Chinese economy over the same time, roughly 20 times greater than it was in the early 70s. And this change in the economic axis of the global economy is very significant. And it has profound implications for so many aspects of business in Ireland and how we'll eventually plan an economy. Because what this is showing is that the structure of the economy will change. The other axis here, the more pessimistic side of the world, shows you US manufacturing employment, down from just under 20 million to about just under 12 million at the moment. Now, that's partly because it takes fewer manufacturing workers to change a light bulb than it did back in the 70s, but it also reflects the change and the change in the geographical location of industrial production. What does that mean in terms of Ireland? What it's telling you there is that you see circumstances in which it's going to be very difficult to envisage widely dispersed, very substantial amounts of industrial production. You'll have specialised areas. You will have significant clusters maybe in certain parts of the country. But the idea, like the Late Late Show, that there's one for everyone in the audience, or more significantly, one for every constituency in the country, that isn't going to roll. So you're going to find probably more significantly dispersed services sector economy on smaller scales, and that has significant implications for planning. The future is quite threatening in terms of this change, but Ireland is small enough, if it's capable, of taking advantage of it. We also have a couple of other elements, because resource change is a very significant issue in the global economy. And while we're focused at the moment, very rightly, on oil prices, there are other elements. This is actually stolen from a colleague's presentation. It's a UN presentation on the quality of soil across different economies in the world. And those of you who have been to the optician lately probably can pick out Ireland and see there that the soil is stable at the moment, which is in very significant contrast to very large parts of the world. So we have a hugely important competitive advantage in this area. The task for economic policymakers is to try and turn that into a significant element of Ireland's economic redevelopment. The task for planners is to ensure that this comparative advantage is fully grasped without imposing significant costs on the rest of the economy. So there are significant opportunities there. I said the world is going to be very different. It's going to be different for a variety of reasons. Money will be scarcer. There's no surprise there. The blue line, which shows you average credit growth in the Eurozone economy, is going to be a thing of the past. The German credit growth is probably more typical. And in the case of Ireland, that's inevitable. If you look at this slide stolen from a recent central bank presentation, you see what was happening in terms of lending in the Irish economy. The reality is the tap that was fully on, pouring, flooding the economy, is now turned off. And over the next couple of years, it will be a trickle that we see in terms of new credit growth. Initially, it's going to be in terms of various distressed asset purchases, maybe helped out by maybe a more significant element of funding through NAMA. Eventually, you're going to see more boutique sort of lending in terms of property, but it's going to be a very slow progress in terms of the availability of credit. And I am talking about something that, where even in the medium term, whatever we define that as, but certainly 4 or 5 years from now, credit will not be freely available. It will be much more significantly rationed. Another reason the Irish economy will look different is that our budget position will be very significantly different. This graph shows you the amount in terms of billions that are supposed to be taken out of the economy. The hard lifting is supposed to be behind us, but there's a fair ways to go there. And to give you some sense of how this differs, or the future might differ from the past, if you look at what was happening to the previous budgets, now that's not the total fiscal generosity, but it tells you the amount that was pumped into the economy in terms of social welfare increases and tax reductions in the budgets in the good old days. I can nearly detect sighs there, kind of, where people just want to be back in that time. Unfortunately, it ain't going to happen. The idea of feast and famine fiscal policy is behind us. We are going to have more sensible budgetary policy. One way or another, we will have more sensible budgetary policy, and that will be a significant issue in terms of making it easy in terms of the planning process, where you didn't have the excitement on budget day of knowing that there was some major new initiative that was going to completely transform the planning environment. So that will be a change. We will instead be going for a rules-based system. Now, a lot of the talk is about this fiscal compact and the rules it implies. These are measures here of the structural budget balance that is, we're supposed to keep to 0.5% of GDP. And the point from all these numbers here is to suggest to you that, first of all, these numbers change. You can't see what the structural budget deficit is. These numbers change hugely over time. I've taken numbers from the OECD 2008, 2011. The IMF, who were lauding the Irish economy in 2007, became its greatest critics in 2010, and now have moved to probably our best external partners in 2012. But what you get there is an idea of the scale of revision to these sort of numbers. One of the problems we have in terms of the economy hugely is we don't know where we are, and this is suggesting we don't entirely know where we've been. We know it's been awful over the last while, but we don't know exactly what sort of element. And there is a delicate element there, and it also applies in terms of the planning process, that besides these sort of structures, these significant rules, you need sense, you need a feel for what is happening in the economy. Economic growth will return for reasons I'll talk about in a moment, but it's not going to be like the good old days. The green line there, Ireland, the purple, is that purple at the top, Greece. Spain has yet to really get its consequences from the economic downturn. Instead, we're going to be closer to the Eurozone average, which is the black line. I think there are a range of possibilities here. You could certainly have a situation, if you look at the lines there, which are in blue and in red, they're Portugal and Italy, and God love them, they didn't even have a party to begin with. Their growth was a little bit like the situation, I don't know, some of you may be old enough to remember a former central bank governor, Maurice Doyle, who talked about the risks in EMU that Ireland would become the Appalachian Mountains of Europe. We didn't, but we had very different types of problems. I don't think we will be the Appalachian Mountains any time either, but we do have to get things right to prevent this happening. One of the reasons I think we will get it right is we see what's happening over the last couple of years in terms of a return to competitiveness. This measures increases in cost. I'm sorry the speed that some of these graphs are coming at you. The numbers aren't hugely important. It's the picture in terms of what's happening in the economy. The green line there is Irish costs. We have been significantly uncompetitive, but we're not as bad as some of the other sinners. And what you see there in terms of Spain and Portugal is a significantly poorer outturn. More significantly, we've started to come back towards the European average and gaining competitive on important trading partners like the UK. We also see, very importantly, the continuing flow of FDI into the economy, very significant. I'm making a very strong medium-term assumption, by the way, in terms of this presentation, and that's that there isn't any dramatic change to the corporate tax structure. If there is, we have to find a new trick in terms of the economy. But the flexibility of the economy, the fact that there are clusters of significant activities in the economy makes me inclined towards a more optimistic view in terms of that. So after all that, what about the property market? Now, I'm delighted that I don't have to do the hard work on that. So in a sense, what I've been doing is preparing the way for the more substantive presentations over the next while. But you'll never get an economist to be silent, so I'm going to offer a tuppence halfpenny worth on this anyway. The first thing is to state the obvious, as economists do so well, and it's the people are very nervous about property at the moment. This graph shows you in red Irish consumer, blue Irish consumer sentiment towards the property market and red Irish consumer sentiment more generally. Quite interesting, obviously they both tanked, but the property purchase intentions is even weaker at the moment. Interesting, the two don't always follow the same pattern. You would, by and large, tend to find the property market doing well in a strong economy. But it's quite notable in 2003 that consumers saw something different happen. They saw the tax reliefs, they saw low interest rates, And as a result, they said, yeah, maybe this is a good time in terms of the property market with all we now know about that outcome. Now, at the moment, the pendulum has swung very significantly the other way. Now, these findings are much more gloomy than a recent DAF study, but they do, to my mind, indicate that people are afraid, they're uncertain about prices, they're uncertain about their jobs, they are fairly certain they're going to find it hard to get financing, so it is going to be a fairly difficult environment. That said, and again, there's about 2 or 3 slides here for the optimists in the audience. I'd mentioned one earlier. This is another one. This is from an IMF report of last week, their new report on Ireland. And what it shows you is, again, something that's probably significantly obvious to most of you, is that there has been a major correction. And that major correction has gone a long way towards restoring a more fundamental order in the property market. What it shows you there in the blue line, or bluey-grey line, is the ratio of property prices to average incomes. The dotted line tells you the long-term pre-boom average, and that suggests we're coming to levels where property is more affordable, augmented by low interest rates at the moment. So that's okay. The yield rate measures on the other axis again show you an improvement there. Maybe not quite where you'd want to be, but making good progress. Now, the very significant thing, we know how far property prices went in the boom, so the likelihood is that we will see some overcorrection in the downturn. And in some areas of the market, we're probably there already. You probably know much better which those areas are. But there are some areas where, in terms of particular niche products, niche segments of housing and that, we probably are in overcorrecting territory. And the critical element is that people start to see a little bit of light in terms of the Irish economy before they turn. Even after that, however, the Irish construction sector will be smaller than it was before. We've lost about 2/3 of output and 2/3 of construction workers. The numbers on Wednesday show construction workers 107,000, down from the peak of 270,000. Even if things improve, we're likely to see construction employment move at best towards about 150,000. That would be consistent there with the sort of employment elements you're seeing, say, in Europe. In the US, however, a much more flexible labour force, a different construction industry has employment there much lower. But there is a little bit of upside from here, excuse me, but it's a little bit away. Housing demand will eventually return. The pendulum has swung so far and so much over the last 10 or 12 years that it will eventually turn. This graph shows you in red the natural increase in Ireland's population. Still very healthy. Yes, there's a couple of bumps around it, but that's a terrible phrase, actually, when I think about it. But there's a couple of moments where let's move on. The other element of it is the black line is the migration statistics, and you can see that they tend to dominate the green line, which is the CSO's very rough measure of household formation that it used in its employment numbers. The encouraging element, a slight turnaround there we're seeing, and while over the next year or two housing demand will continue to be really depressed, these sort of numbers are pointing again towards a medium-term demand, probably 35 to 40,000. It's not going to be today, tomorrow, or probably the next day, but again, in this magical medium term, when people believe the economy has turned, there will be an improvement in housing demand. And that actually will need some supply. A couple more minutes, right? I know I'm just running towards the end of time. This shows you US housing stats. The red line is the total number of housing units. The blue line, the occupied housing units. So while it's not like the situation here, you do have to have some sort of vacancy rate. The critical issue is the right sort of vacancies, because the black line there shows you the housing ownership rate, and you can see after a massive government incentives to try and boost home ownership, it started to retreat and we're going to see the same sort of development here. It's almost impossible to predict how much that home ownership rate will retreat, but we know it will in terms of a changed array of options for householders, and I'll talk about those very briefly in a moment. The other thing that's worth looking at there, doesn't look maybe particularly significant, that little blue and red bump around 2000, changed measures, changed ways of looking at the housing stock and measuring it, and you lose about 5 million houses. One of the things economists assume, policymakers assume, everyone's assumed, is that we have very decent statistics. Now, we'll have the house price register hopefully a little bit late, but we're still way behind in terms of the statistics we need to turn things round. Question I'm going to leave you with in a moment, but question I'm going to leave you with about the boom. We know there's enough blame to go round, but there is a sense in terms of people like me who looked at the trend in housing completions and looked at population and saw them broadly going in similar sort of terms, knowing that there were some issues in the housing stock. We probably felt things were a lot better than they turned out to be. But really what happened there was that we accelerated away. It was a little bit like the kid who sees the cake at the birthday party and stands, again, it's a little while since my kids were this age, but there was always one kid you had to keep away from the birthday cake because they would just stand over it and devour it till it was gone. The Irish economy was a little bit like that through the boom period. The boom was far too fast for comfort. But the problem was we didn't really know what the safe speed limit was. And the difficulty there is that once you go on this, once you start at that cake and get yourself in there, the reality is you don't think about how nice it is or whatever. We didn't think about the quality of the housing stock. We didn't think about the location. We didn't think about the particular types of property. It was a case, build them high, move on to the next town for the circus. And that was the sort of issue. We really need circumstances in which both economic policy and planning deliver us from that sort of concentrated boom. And this is a question, again, I'm going to leave some of the other speakers with. It's how do we actually ensure, not that just planning prevents the mistakes of the last couple of years, because in some sense, don't allow anything happen in the world, and that prevents the last few mistakes. But more significantly, how do you actually contribute to a constructive, a safe speed limit in terms of the housing market? Finally, I'm winding up. Some implications of these sort of changes in economic circumstances. Housing will be more expensive for a couple of reasons. First of all, we all know there will be significant property taxes, and they will remain a key element, again, a very changed environment. Second, we know mortgage relief is going to be phased out. Third, we're going to have higher borrowing costs. That will be because interest rates will be a lot higher on average over the cycle than they are at the moment. We know that margins that banks charge will again be wider to reflect a true cost of capital, which was lost in the competitive frenzy of the boom. And the third element is that there will be fairly significant constraints on loan-to-value ratios. And if you think of someone on 40 grand trying to buy a house at 160 grand and now having to find 16 grand more than at the time of the boom, that's going to maybe put the average property buyer back 3 or 4 years at very least. So you're going to have that has very significant implications for the rental market, as these do as well. The extent to which we become a different country, more European, and more willing to contemplate changes in the nature of home ownership or home occupancy. As well as that, we're going to need a more flexible industrial structure. It's very important there that what I've been trying to suggest to you is the world is changing very fast. So the idea that you can set up a big plant in every town and leave it there for 20 or 30 years just isn't going to work. You're going to have more clustering within some high-tech areas and more remote working. So the critical infrastructure is going to be broadband as well as transport access rather than this massive sort of industrial centres. The likelihood is in a more service sector economies that companies themselves will have shorter lives. You're not likely to see the sort of huge organisations that we've seen in the past in the main. Small is going to be beautiful, and in that respect, we're going to see that sort of churn create a constant demand for renewal, refurbishment, and change and flexibility in terms of the structures we build. So getting the economic environment is going to be a key contributor to the turnaround in the economy, but there are more questions rather than answers in terms of the economic outlook. The answers, I suppose, first to say that there will be a future. There is progress being made. That future will be significantly different. All types of planning, economic, property-related, will be hugely more important. You know, it wasn't a case of if we have it, we spend it, life is good, sure, aren't we Irish, and everything is wonderful. And the critical aspect that maybe a seminar like today really can, what will we actually learn from our mistakes? And the short, the narrow answer is, let's not do that again. Let's